New this morning, Ant Financial is planning to fold its financial operations into a holding company that could be regulated more like a bank. That's according to a Bloomberg report. The new holding company would absorb any unit that would require a financial license. Alibaba owns about a third of Ant Financial. That stock rose 5.7% overnight after a two-day decline of 16%. Meantime, the U.S. government strengthened an executive order barring U.S. investors from buying securities of Chinese companies that allegedly have ties to China's military. The Treasury Department said that the November executive order applies to investors in ETFs and index funds, as well as subsidiaries of Chinese companies on the banned list. Since the order, index providers have already begun shedding some of the designated companies from their indices. Joining us now to discuss all this, DeWardrick McNeil, Longview Global Managing Director and former Obama Defense Department appointee, and Joe Terranova, Senior Managing Director at Virtus Investment Partners. Guys, good to see you. Joe, I'm going to start with you because in yesterday's session, we saw a real bounce in Alibaba shares, and I'm wondering if you think the stock is calling the bluff of Chinese regulators and or just simply reached a valuation or values, which basically levels since we haven't seen since June, that account for all of this.
Well, I think the suggestion would be that speculators believe that, in fact, it is an opportunity, and as you stated, it is calling the bluff. I would argue that's not necessarily the right strategy looking forward. I think what happens here is the action on the part of Chinese regulators really highlight the investment opportunity that remains with large and mega cap technology companies in the U.S. Apple this morning is going to be approaching an all-time high, exceeding the September 2nd high. So I think it illuminates that. I think if you're looking for opportunities here, the first place you want to look at is the ETF, the MCHI, that's the iShares China ETF. Four of the largest holding are the Chinese internet giants. It's 35% overall of that ETF. And to a lesser extent, Pinduo, PDD, that's an opportunity as well. If Chinese regulators remove the exclusivity that merchants have, Pinduo will benefit as an e-commerce platform that will see a scale and its availability increase.
DeWardrick, I think a lot of investors were sort of caught off guard by regulators in the probe specifically into Alibaba, in that the conventional thinking was that these companies are state champions and that there is sort of a inherent backing by the government to make sure these companies succeeded. What is the game plan of the Communist Party, do you think? What's the end goal?
Well, Melissa, I think you're right. A lot of people assume that because of the ongoing or soon-to-be U.S.-China tech war, that these guys were the new masters of the universe and untouchable. But the problem with that is that there are a lot of things happening at home domestically with these companies that China, the Communist Party in particular, was unhappy with. One of them was showing contempt for regulators. The other was damaging consumer rights, which, of course, hits at social stability by forcing consumers to buy on one platform, the so-called captive ecosystem. So ultimately, the Chinese were going to have to regulate this sector so that they can control what I think they will be doing going forward, both at home as well as abroad in the tech war. But this is not just an Alibaba story or an Ant Financial story, Melissa. The Chinese have signaled that they're going to crack down sector-wide and that they are going to deal with some of these exclusive or captive ecosystems. And that will open up this sector a bit more to Pinduoduo and JD.com and other companies in the space. For so long, Alibaba has squatted on the space, and regulators have made it clear that that's not going to be allowed going forward.
Shepard Smith here. Thanks for watching CNBC on YouTube.